I hope your Thursday, June 6th, is going amazing so far. So I want to jump right into it here today. The process of investing, risk management, cash management, and investment management. What does this mean? And why am I bringing this up today? Well, I had the pleasure of joining someone in their live trading session this morning. And I'll say, I found it interesting. It was difficult. As I was watching it, I found it very difficult to follow. He was trading futures, so he's on a minute chart and he's moving really quickly. And I'm sure some of his setups were predetermined. He knew he has his buys and sells. He knows where they are. He knows where he's going to enter, where he's going to exit. He has an idea of where he thinks things should or could go, but they can always move against him. So he'll have the opposing order in place. And to be quite honest, I thought about this through the eyes of someone that was investing money, or even through an advisor trying to watch this guy and learn. And what I realized as I was watching this was that I understand his process, and possibly some of the things that seemed like contradictions really weren't. He had setups both ways just in case. It's a way to manage risk is all I'm saying. And now you could take it one of two ways. You could take it that way, or you could say, look, the guy, it's double talk. He doesn't appear to know what he's doing. He says if it goes here, he's going to go long. If it goes here, it's going to go short. And then when it went there, he didn't go short. And he said, see, I told you I'd go long. And so I know how that can seem. So I want to talk about this morning. What are these three? These are the three pillars of investing, everybody. And you have to have a very well-disciplined, structured set of rules and processes that fill in your risk management, your cash management, and your investment management. So today, rules are they're individual. Okay. What might be a rule for me will be a little different for you and will be a little different for the next person. And that's why this idea of mass investing is so difficult for me to comprehend, because if you take one person and say, well, the acceptable loss here is 18%, but this person sitting over to their left, if a loss exceeds 11%, their emotions will overtake their mind and they will bail. Plain and simple. If your emotions overtake your mind, you'll bail. So this mass investing kind of process is a very difficult process for me to understand. And I worked for two of the biggest firms on Wall Street for a decade. And then I worked for myself for, 7-8 years. So as a wealth manager, financial advisor, whatever you want to call it, the only difference was I was very focused on the investment management. And I did not have, hundreds or thousands of clients, because I did not operate that way. It was a very individualized approach. There are similarities, but let's just get into it. So what is your risk management? Risk management is very simple. So when you are when you are investing your money and you want to identify areas of risk, areas of high risk, believe it or not, are quite contradictory to what you would think. So most people are going to look at areas of high risk as these areas where perhaps price has just fallen. It has just been tumbling. The economy's in the toilet. So some people are going to look at economic conditions. Some people are going to look at the price of investment, and they're going to say to themselves, gosh, these are areas of high risk, when in fact, you almost have to flip your brain around and realize those are not areas of high risk. When something has fallen 40 or 50%, especially an index, this is not talking about individual securities. I am talking about an individual index. So the S&P 500, the NASDAQ, the Dow. When prices have fallen 40 to 50%, these are areas of opportunity, not areas of risk. Now, conversely, if you are focused on price and you have these areas where price has gone up, and you go, hey, we've been going up for 7-8 straight years, piece of cake. You don't have to do anything but buy the dips. If you start hearing conversations like that, we are now in areas of high risk, not opportunity. You have to flip the way you think when you invest. Now, Just because you're in an area of high risk, does that mean that you start buying shorts or going short or betting on when the trend is going to turn? No, it doesn't mean that. It means that you are on alert for the time that price is going to change trend, price is going to turn over. What is the best way to identify areas where price is most likely going to turn over? So you're at a high price. This is high risk, not high opportunity. How do we know when price is going to turn over? Well, there's several ways, but what you want to do is you want to primarily look at the footprint of institutional money. The footprint of institutional money is very big. Trading activity is the footprint. As we go over time and time again here, we're looking for large trading activity, or we're looking for very, very, very low levels of trading activity. Now, the difference is this. When you see very low levels of trading activity, that simply means that people are not interested in buying at these prices. That will traditionally mean that you are looking at a correction, some correction to get to a point where prices are more attractive, typically 2 to 5%. I don't mean a correction in the index, although it could turn into that. That is less doubtful. I am talking about a correction in that index that just leads to a 2 to 5% kind of rollover where prices become more attractive. You'll see volume pick up. That will be purchasing by the bigger, stronger hands, and off we go. Now, if you see volume at when we're in rising prices without corrections are areas of risk, remember. Now, if you start to see large trading activity at those high prices, you're probably looking at a market correction or a recession, depending on the level of trading activity increase. If you start to see 2 and 3 and 400% more trading activity, and for example, in 2021 in December, we saw that, and it was during the holiday season, you are in for a correction or a recession type rollover in market price. Okay. That is risk management. And on the converse side of that, as prices are tumbling in indexes, and all of a sudden volume starts to pick up, that initial pickup of volume, is that where you jump in and start buying? No. You're now aware that the big institutions have taken an interest at price at that level. Okay. I go over in my VIP mentorship and in my course, it's actually the second stage of my system. I go over how to identify tops and how to identify bottoms. Bottoms can sometimes be a little trickier, but they're also somewhat easier because the scaling in process is very easy to identify, which brings us over to cash management. What is cash management? Well, cash management is pretty simple to understand. If you look at it from a large sense. So you're always hearing people say buy the dip, right? Everybody's kind of understands what buy the dip means. And buy the dip simply means when prices are in an uptrend, again, we're talking about indexes. When prices are in an uptrend and they dip that 2 to 5%, which I just told you a very simple way that we can identify that. That's one piece of the puzzle, but it is a way to identify that. When that 2 to 5% dip comes, you want to buy that dip with the institutional investors. Now, how can you continuously buy that dip if you're not adding money? Well, what did we just discuss? We just discussed risk management. So if you're getting out of the way, so you say, "Oh, look, there's no trading activity here. Trading activity's fallen off. I'm going to raise my cash position by 2%." We're not talking about major swings here, folks. 2%, I'm going to raise my cash position. Well, now, as the dip comes down, guess what you have? 2% more cash so that you can buy the dip. What happens if you have poor cash management? What happens? Well, let's just say that your goal is simply to stay out of the way of very large bear markets. So you say, what I'm looking for is December of 2021, and I'm not interested in anything else. And I can tell you in December of 2021, trading activity volume was up almost 500% 3 weeks in a row during a holiday season. So if you didn't see that coming, or your advisor says there was no way to see that coming, or whomever, there was no way to see that coming, that is completely inaccurate. You could absolutely see that coming. You could see that coming almost if you were wearing sunglasses at night. Okay, that's how obvious that was. My accounts made 21% on the way down, because when I see those big areas like that, my personal investment philosophy is to go short. So I'll go to cash as it rolls over. Price will break a support level, it'll bounce back up to retest, and as it retests, if it rolls over, to go short. Okay, that's a little outside the realm of what we're discussing here today. Point being, if that happens, basically, even if you are the most conservative investor in the world, and for a lot of retirees, they consider themselves very conservative, because they can't make up losses, right? They've put their money into the pile. They've put their money into the retirement pile, and they don't want to suffer losses, but they do need gains, right? So a lot of times what they'll do is they'll go neutral. They'll just simply cover their positions. All right. That's again risk management. It's another step of risk management, and that also gets us into our next point, which is investment management. But when I say cover, I mean they own as much of, like, say, the S&P 500 as they are short, which means they won't make money as it falls, but they won't lose money as it falls. Okay. This is also a great tax strategy to utilize. That way, you're not buying in and selling out all these short-term gains and losses that really run up tax bills. I never advise anybody to do complete short-term trading unless they're a really young guy and they are fit and suited to day trade and they want to do this. That's a little bit different. Outside of that, I don't ever see any reason to be. You need 50% of your assets should always be in a long-term strategy. And then you kind of scale the other 50%. And that also is investment management, which I'm not trying to skip over cash management, but point being, that is also investment management. It's funny when I get talking. And I can see how sometimes I might even lose people, right? Just like that guy earlier, I thought, if this is just the average guy watching this, he's lost. And I'm probably just did that right now because I was discussing December of 2021 and getting out of the way. So if you you could simply take half your money and go to cash, right? Some of your short-term money is cash. As that market falls, and then you see that trading activity pick up at the bottom, you start to scale back into your positions. Well, where did that cash come from? It came from selling up here. It's the only way that you have to have cash management. You have to have cash on hand, which means a piece of your overall strategy has to be when you raise cash and when you use cash. How much cash are you consistently keeping in your reserves? Some people, it's 10% they want to consistently leave in reserves. They always want 10% cash. Some people, it's 5%. Your cash management is dependent upon how often you may actually need that money. So if you're a retiree and you withdraw 5% a year, you always need 5% cash available to you. But in fact, it's going to be slightly more, right? Why is it going to be slightly more? Because you're going to need to raise cash in order to buy investments when it makes sense. When risk management tells you, oh, this is a low risk buying opportunity, you need to have cash available to do that. So risk management is nothing more than identifying areas of high risk and areas of low risk. Okay. There's a process to do that. Cash management is the process of making sure that you have a specific amount of cash available to you at all times. So you are able to buy the dip. So you are able to buy an opportunity. Now, what is investment management? Investment management is effectively what is the best investment for this environment. It's really that simple. What is the best investment for this environment? Well, if you're in an environment where prices are steadily increasing and it looks like everybody's buying the dip, the best investment for that environment is going to be, if you are buying, growth-oriented indexes, right? So you're going to want to go to your growth. You're going to want to go to the index that has your strongest index, the index with the best price move per dollar. And right now, that would be the NASDAQ. Tech is moving more efficiently than the S&P, more efficiently than the Dow, and definitely more effectively than your small and mid cap, your Russell 2000. So that's your growth. Now, if you are in a falling market and you say, I am going to start buying, you are a value investor. You are looking for the investment that has an intrinsic value, the highest intrinsic value, based on the market decline. Okay. So if the market decline is the steepest in, say, in your NASDAQ, and you have a 35%, push down, what's going to fall the most? Most likely right now, it's going to be your AI positions. So when you're looking for value, they're probably going to take the biggest hit as well. And they're probably going to rebound the strongest. Your value is probably going to be in artificial intelligence. Okay. I'm just giving you an example. You would have to actually watch that play out to say where the greatest value lies. But that's investment management, buying the best investment for the type of market that you're in. Cash management, making sure you have cash available for withdrawals if you need them, and also to buy opportunistic investments when they come to pass. Risk management is simply managing areas of high risk and then managing areas of high opportunity. It really is that simple. That's it. All right. So thank you, everybody, for joining me today. If you're having a tough day and your mental health is suffering a little bit, listen, get outside, get in the sun, do some exercising, smile. Sometimes just smiling will make you feel better until you really are smiling. Remember, this too shall pass. Every day above ground is a great day. Thank you so much for joining me. Real quickly, I do have my VIP mentorship, EQ Mastery, financial and investment course or piece of my system starting here in a week or so. Why do I call it EQ? Because your emotions are played with the most when it comes to investing. And how do they do that? They do it through improper risk management, improper cash management, and improper investment management. If this interests you, reach out to me. I have to show that little plug at the end. I probably should be doing it before I get started as well. Okay, I will see you